Welcome, everyone, to the Vested Interest channel. This is Shane, and this is our weekly portfolio update video. In this video, we're going to cover the $1,066 in new capital that I added to the portfolio, what we bought with those funds, any options I was in for the week, any dividends we received as well. Now, big change to the portfolio. You can see it looks like I lost a lot of money this week, down to $468,754. We will talk through why it looks like that. That is a bit misleading, but let's jump into the portfolio update and get this one rolling. Before we do that, if you could hit all of those buttons down below, make sure you're subscribed, hit the like button, join the channel, join us on this journey to financial freedom, share with anyone you think that might find value in the content, hype up the videos if you can. All of that really does help out the channel and spread the videos a little further. All right, and first up on the list, we're going to cover options, and we did have one options contract you can see here, sold to open, one covered call, -1 is one contract. It represents 100 shares of Google. We opened that on the 4th of May with a strike price of $400. That's what I was willing to sell Google shares at, with an end date of May 8th, which was Friday. To do that, we were charged some fees, $1.50 plus 50 cents plus that 4 cents. So we received, $1.50 is what we received in options premium. Then we were charged 54 cents in fees. So we received $149.46 in options premium. And as you can see, it was assigned. Shares of Alphabet of Google there did hit just over $400. I think 440 cents, 60 cents, somewhere in there. So we did sell those 100 shares. So that is the downturn in the overall portfolio that you are seeing, because we have not redeployed that capital yet, and we will be redeploying this capital. Actually, we will probably be selling out of Alphabet, Google altogether, and rolling those funds into a couple other positions that we will talk through later in the video. But that $39,999.15 is the difference in the portfolio that you saw on the beginning slide there. So this is sitting off to the side in cash. And we will talk about what we're going to do with that cash and what we're going to do with the rest of the Google shares here later in the video. Dividends, nothing to speak of in dividends. We did not receive any this week, so quick pass through that. And on to the new capital invested on the 4th. Not only did we run a covered call on Google, we also invested $718.99. With those funds, we bought 5 more shares of Comcast Corporation, ticker CMCSA. Bought those shares at $26.97. Bought 1 more share of Domino's Pizza, ticker DPZ. And Comcast is out of the communication sector. Ticker DPZ is out of the consumer discretionary sector. Picked up that 1 share at $338.89. And added 2 more shares to our Badger Meter position, ticker BMI. Picked up those 2 shares at $122.63. I hold Badger Meter in the industrial sector. I know it is out of the information technology sector. Dividend income added with these additions here, $17.76 in passive income, dividend income over the next calendar year. All right, and I wasn't done. I went back into the portfolio on May 7th, which was Thursday, added an additional $347.98. With those funds, we added 2 more shares. This is part of our weekly buy, Vanguard's International Dividend ETF here. VXUS, 2 more shares at $84.48. We're buying this one every single week, regardless of the market. 2 more shares added to our Pfizer position, ticker PFE, out of the healthcare sector. Picked up these 2 shares at $26.41. And our other weekly buy is SCHD, Schwab Strategic Dividend Growth ETF. Picked up 4 more shares there at $31.55. These new shares add an additional $12.23 in passive income and dividend income over the next calendar year. Total invested for the week, $1,066.97. This does include the options premium we received for running the covered call on Google. Total weekly dividends added, that's not, we didn't have any dividends, so that's correct. So 0 dividends for the week, and then total passive income added $29.99. All right, quick run through the sector weight allocation update here. Communications makes up 9.24% of the overall pie. Consumer discretionary at 3.17%. Still adding to the Domino's Pizza position right there in that slice. Still adding to Comcast in the communication slice. Consumer staples at 6.75% of the overall pie. Energy makes up 10.33% of the pie. Financials at 6.88%. Healthcare makes up 9.69% of the pie. Industrials at 6.98%. Technology makes up 12.44%. That reason for the big drop here was the sale of Google again, and we didn't sell it outright. We ran a covered call on it and said we're willing to pay or willing to sell at $400. Someone was willing to pay $400 per share for Google, so we let those shares go at that price because it did run up at $440 or $460. So that's what happens when you run a covered call. You set the price you're willing to pay. If it goes beyond that, you sell those shares at that price. Now, because we received some dividend premium or option premium for that, we actually sold at 401 and some change, so a little bit higher than what it was at, but it could continue to run up. So that is the downside to options. You are capping yourself on the upside. So like we saw with Lamb Research, it's continuing to run up beyond what we sold it for, but I'm all right with that. I'm willing to live in that 20 to 80% range. 20% gain to 80% range. I might not get the 100% payout or run up, and I might not get to complete bottom if I choose to sell on the way down. But if I can live in that 20 to 80% range, I think I'm doing just fine, and I'm going to continue to do that and grow this portfolio that way. It is one of the ways to do that, taking gains. I'm never going to apologize for taking a gain. I made money on those shares, and I have a couple of options to roll them into that we will talk about here in a little bit. All right. Where were we? Materials makes up 3.53%, utilities at 4.13%, REITs and real estates at 10.12% of the pie, and ETFs is the largest slice of the pie now, for right now, at 16.72% of the overall portfolio. Over here to the right, you can see the same percentage amounts that match up to the pie on the left, as well as the dollar amount allocated to each sector. All right, here it is. I show this every single week. I think it's important for those of us in this space to show you that we are in the market with you. At least I am in the market with you. It's not something that I'm just talking about. I am investing right alongside of those of you who are doing that as well, putting my money to work, growing this portfolio, trying to grow my passive income, and eventually reach financial freedom, which to me means that the portfolio pays all of my bills. All right, so all of the different positions in the portfolio in this column, total shares that I have here, current price of each share here. Google ended the week at $400.80. So again, I was willing to pay this or sell this one. Someone was willing to pay $400. So they got the shares for $400 and they saved the 80 cents. But again, I got a little bit more options premium for being willing to sell them at $400. So really my sale was $401 and some change. Which is fine by me. Again, my thought here, let me talk through this real quick before we run through the rest of the overall portfolio here. My thought here is that I have a couple of other stocks that have made it onto my watch list recently, if you've been watching the Stock Pick of the Day series, and I have done some research into those companies and would love to add them. Now, part of the reason Google is ending up on the chopping block, one, it's run up 153% in the last year, right? So I feel like it's a little overweight right now. It was a little over 10% of my portfolio, so it was overweight for my portfolio, but I also believe it's overpriced right now. Now, I could be completely wrong. Again, maybe this one runs up to $470, $480, $500 per share. Definitely could happen. The stock market does crazy things from time to time. But for me, I am comfortable saying I have a couple of other opportunities, and it is two opportunities that I believe are undervalued right now that I would not mind taking these funds and rolling into those positions. And the two positions would be one, MasterCard, and the other one is Accenture. Those are the two positions that I will be rolling these funds into. So I will most likely be selling the remaining 38 shares. I may do what I did with Lamb Research, keep a little over one share and hold it until Google, has another big pullback and then add it back into the portfolio. I may sell them all. I haven't really decided yet on that, but I definitely want to do that with Lamb Research. Eventually, I believe it's going to pull back and I'll buy this one, under $149 and some change. I'll be able to jump back into this one, I think, in my opinion. Might not happen. I might be completely wrong. I might end up selling this 1.6 shares sometime in the future. So I might do something similar with Google. Another reason why it is on the chopping block, I've recently looked at my portfolio and I see a lot of these positions that are really not growing their dividends very fast, right? Google has such a low payout ratio. Its yield is only, my yield on cost is only 0.558. Its current yield is even lower than that at 0.22%. Recently raised its dividend. You can see it's highlighted in yellow. And the raise was again 5%. But it is under 20% payout ratio. So I hate companies that have such a low payout ratio, but they're only raising their dividend 3, 4, 5%. The way this one is running up, the amount of shares I'm getting reinvested back into Google are negligible. It's fractions of a share, very small amounts. It's not doing a whole lot of compounding interest, and I'm not adding to Google right now at these prices. I'm just not. It's overvalued in my opinion. So I'm not adding anything, which is not helping the compounding. And 5% compounding when the stock is running up the way it is not adding much. Again, 0.1 share, 0.01 share, whatever it is very minimal adding to the compounding. Now it is getting growth. You are seeing price appreciation growth, but that is more in line with a technique that looks at growth as the main driver and then wants to sell those positions in the future. Well, I'm comfortable selling it now. I've seen the growth. I've seen 153% growth over the last year, so I've seen growth in it, so I can sell it off, capture that growth, and roll it into other positions that have a higher yield. Or Microsoft doesn't have much of a higher yield. I think it's a little higher, 0.7%. Or I'm sorry, not Microsoft, MasterCard. MasterCard doesn't have much higher yield. I think it's at 0.7%. But it is growing its dividend at double-digit rates, which is what I want to see with a company that has such a low payout ratio and such a low dividend yield. So hopefully that makes sense why I'm doing this. I'm looking for dividend growth. That's what I'm looking for, right? 5% is not terrible dividend growth, but it is not much for a company with such a low yield and such a low payout ratio, right? Whereas something like Microsoft is a low payout dividend yield as well, 1% yield, but it has a double-digit dividend growth, 9.88%, just under double digits. So I want to see these companies with such a low yield to have better dividend growth, I guess is what I'm getting at. I'm also questioning, do I continue to hold something like Johnson & Johnson with only a 3% dividend growth? Do I continue to hold something like Procter & Gamble with only a 3% dividend growth? Do these companies offer anything more than SCHD is giving me? Which right now they really don't. I mean, they were at 5, 6, 7% before, but they've really pulled back on their dividend growth, right? And my yield on cost, 2.8%. Current dividend yield is 2.97%, while SCHD is at 3.3%. So would I be better off just rolling these into SCHD, for example? Right? I'm getting better dividend growth with SCHD. I'm getting a higher dividend yield with SCHD than I am with these other positions. So I'm starting to look at the overall portfolio and say, okay, if the ETFs are going to be the biggest drivers of the portfolio, do I just want to cut losses? Not really even losses. This one would be a loss. I'd be down on Procter & Gamble. But Johnson & Johnson I'd be up on. But do I really want to cut these and say, hey, the dividend growth is not worth, the juice is not worth the squeeze here with such low dividend growth? If I'm getting lower dividend growth, 3.5% yield on cost right now, 3.3% current yield on SCHD, would I be better off to get a higher yield with SCHD and a little higher dividend growth? So that's the way I'm looking at the portfolio. That's part of the reason that I was willing to let Google go at $400 per share. One, I believe it's overvalued. And two, the dividend growth on it with such a low yield is not really in line with what I'm looking for with the position. Again, could very well continue to go up. This one could end up being a $500 stock in the next 6 months. So I'd lose out on that $100 per share, and that is the that is the downside to selling a position. If it continues to go up, you look like a goofball. But if it goes down, then you look like a hero. But I'm looking at it as what does it add to the portfolio? Yes, it's adding growth, which 153.99%, I can, lock that in right now, which I already have with the 100 shares. I could lock in the rest of it with these 38 shares and roll those into other positions that have better growth and higher yield, which will add to my estimated annual income a little faster. That's the idea behind those two sales. We'll talk through that more whenever I make those final decisions this week, but it's looking like I'm going to sell out of the rest of Google. I'm going to roll those, probably split it equally, maybe 20,000 into Accenture, 20,000 into MasterCard, and then I'll put the rest off to the side to help pay the taxes that I'm going to have to pay on selling this one. Because I think this one will be a short-term gain rather than a long-term gain. I can't remember exactly when I bought Google last year, but we might be just under the 1 year mark, and you need to be over a year to have pay a lower capital gains on this one. I need to look at that, but I'll put some of the money aside and make sure I can pay the taxes off on that one. But anyways, market value of all of the different positions in here. That's what I'm thinking with Google anyway. Accenture and MasterCard, maybe 20,000 into each. Accenture has a much higher dividend yield and it has higher dividend growth. MasterCard has a little bit higher dividend yield, but double-digit dividend growth. So that's the reason I'm looking at those two positions. We'll talk through that. I believe both of them are undervalued right now. Much more undervalued than Google is. Google's value to me right now is actually overvalued. But that's just my opinion. Maybe some of you think it is worth $450. Maybe you think some of it's worth $460. That's up to you to decide. All right, market value in this column, average cost per share here. This does include reinvested dividends. My purchase price, again, does include reinvested dividends in this column. Whether I'm up or down, you're going to see it. You can see my biggest loser right now is Badger Meter, down 28%, closely followed by Comcast, down 25%. So, everything else is up. Well, Pfizer is still down, which I've been adding to a little bit recently. And Procter & Gamble is down, which I haven't added to maybe in the last couple of weeks, but maybe a few weeks back I was. Percent return, again, you'll see it here. Which sector each position falls in this column, whether they're a quarterly, semi-annual payer in this column, and the yellow are just the positions that have already raised their dividends for the year. Current yield in this column. My yield on cost here, portfolio weighting. I do have a rule in the portfolio. I do not want any one position to be more than 10% of the portfolio. I do not want any one sector to be more than 20 to 25% of the portfolio. Estimated annual income in this column, dividend growth year over year in this column. And this, again, is one of the things I'm starting to looking at a little more heavily in the overall portfolio. I'm seeing some positions, especially ones that have recently raised their dividend, that have really dropped off on the dividend growth. Now, maybe it's a short-term thing. That's why I'm not in a hurry to sell Johnson & Johnson. Maybe next year it goes back up to 5 to 7%. Same thing, Procter & Gamble down to 3% dividend growth. Maybe that one, goes up to 5 to 10%. Now, Pfizer at 2.48%. The only reason I am willing to accept slower dividend growth for something like that is look at the yield on cost, 6%. Right? So I have above 6% yield on cost. So I'm all right with around 3% dividend growth. Same thing with Verizon, right? I have a 6.87% yield on cost. So I'm all right with 2.5 to 3% dividend growth. But these ones that are, like I said, Procter & Gamble, less than 3% yield on cost, but only 3% growth. Well, does that offer anything better than SCHD does? I don't know that it does. I don't think that it does. Johnson & Johnson, same thing. Now, 3.5% yield on cost, that's getting up there. That's a nice dividend yield. But 3% growth, well, I can lock in 3.3% current yield with SCHD with the higher dividend growth. So would I be better off rolling, and would my overall returns and dividend growth be better if I rolled some of these slower growers like Johnson & Johnson and Procter & Gamble into SCHD? It's just as defensive, right? They're defensive holdings. Johnson & Johnson and Procter & Gamble, I would consider both of them defensive holdings, but I would also consider SCHD a defensive holding. So again, am I gaining anything more than holding SCHD by holding these other positions? That's how I'm looking at the portfolio. Google, same way. With such a low yield on cost, dividend yield, and current dividend yield even lower than that, the 5% dividend growth just isn't worth it for me. I want double-digit dividend growth with something with such a low dividend yield. That's what I'm looking at with these positions now. What do they offer beyond the ETFs that I choose to hold? What's the benefit of holding something instead of having those funds in SCHD or VTI or VXUS? If they don't offer something that offers me more benefit, higher dividend yield, higher dividend growth, growth overall, which Google has given me, but now I can roll that growth into something else. So I like growth in the portfolio. I liked the growth of Lam Research. That's why I sold off that and rolled into other positions. But I want to continue to grow the portfolio and use that growth to grow the portfolio. And I've kicked myself in the past for watching some of these positions run up 153, 90%, like Owens Corning ran up 90% and then it pulled back. Right? I could have sold it when it was up 90% and bought back in whenever it pulled back. Same thing with United Health that I recently sold. I watched that one run up to 60, 70% last year. Could have sold it, but instead I held it, ended up selling at a loss whenever we bought other positions like Microsoft, instead of locking in that gain whenever it was up 70, 80%. So I'm looking at the portfolio and looking at some of the mistakes I've made in the past, saying I'm not going to make those mistakes again. And part of those mistakes were watching positions run up 60, 70, 80, 90, 100%, holding them, and then watching them fall back down, reinvesting in them as they came back down. Certainly, I've built out the Owens Corning position certainly more than I had it built out before, but I missed a huge run up here over the last couple of years that I could have locked in gains, moved those funds into other positions, and then bought them back whenever they ran back down anyway. So that's how I'm looking at it. Hopefully that made sense. Let me know what your thoughts in the comment section down below. Current yield on cost, portfolio weighting in this column. Like I said, I do have a rule in the portfolio. I do not want any one position more than 10%. Do not want any one sector more than 20 to 25%. Estimated annual income here, dividend growth year over year in this column, payout months in this column, and where a company sits at 15% of a 52-week low. I like to use this column as the high water mark for my average cost per share. Now, total shares, 7,999.499 shares. Market value of the portfolio, $468,754.06. Again, big pullback there is because we sold off 100 shares of Google. So they were called away. I guess technically we didn't sell them off. They were called away because we ran that covered call on them. Either way, it pulled some funds out. It's sitting off to the side as cash. So that's why you're seeing that big downturn. Average cost per share. My purchase price, I do have $404,261.86 into the portfolio, plus the cash that's sitting off to the side right now. Total return still up $64,492 or 15.95%. So that is one thing about selling out of positions. It really does mess up the percent return because obviously whenever you reallocate those funds, that starts over. So this is never going to be quite right. The overall portfolio returns are much higher than this. But unless I showed all the cash that we pulled out of the portfolio recently and in the past, this is never going to really look right. So I just let it be what it is. And if people look at my portfolio and think, oh, you're only up 15%, I just, take it with a grain of salt. I'm not concerned with that. They don't know unless you've been watching the overall channel for the length of time. And those of you who have, the money that I pulled out of the portfolio and set off back into my account as cash, waiting for a rainy day or reallocated across the portfolio, which is why the portfolio continues to grow. But this is not really what I'm focused on. I've said this before. It is nice to see, and some people focus on total returns, and that's their sole focus, and eventually they want to do the 4% rule and live off of their portfolio by selling off chunks of it over time. I'm trying to do something different where I'm living off the dividends in the future and not selling off shares. Not saying I don't sell off shares from time to time, but typically whenever I sell off shares, I roll those back into the portfolio, into other positions that I feel are undervalued or into existing positions that I feel are undervalued. That's what I do with those funds. And that's how I've been able to grow the portfolio so fast, partly. One, I do invest more than most people, but two, I've also sold off big chunks whenever I have those big gains like Lam Research, like Google right now, and reallocate those funds, to better positions or better opportunities, in my opinion. Love Google. I think Google is a great company. Again, I don't like them at $400 per share, but if they were to drop to $200 per share, I'd add them right back into the portfolio and be buying again. All right, portfolio salary currently producing an average of $1,256.66. per month, $290 per week, per day is $41.31, and per hour is $1.72. Again, so not only did we see a little bit of market value drop because of that sale with the cash sitting off to the side, it did impact our portfolio salary as well. That will be a short-term impact. This is definitely going to go up next week after you see the additions of Accenture and MasterCard, which I'm going to be adding this week. You will see the reason I added to it, and you're going to see the market value come back up significantly. You'll also see the portfolio salary jump up quite a bit as well. Current yield, 3.21%. My yield on cost, 3.73%. And this is what I'm focused on, the estimated annual income produced by all of the positions in the portfolio. And it is down this week, but typically it continues to grow week over week, month over month, quarter over quarter, year over year as I add new capital, as the positions in the portfolio raise their dividends over time, as those dividends get reinvested, which I do have the drip turned off, so I am manually reinvesting those dividends right now. And as companies raise their dividends and we add new capital from week to week. Dividend growth, 6.28%. This is going to go up as well. So you're going to see the reason next week is going to make more sense why I was willing to let Google go out of the portfolio. You're going to see my estimated annual income jump up, probably close to $16,000. You're going to see the dividend growth jump up close to 7%, and it's going to make a lot of sense why I'm making the changes that I'm about to make in the portfolio. Part of those changes have already started with the sale of the 100 shares of Google, or the called away shares of Google here from that covered call we ran this week. And then I'm going to sell out of these other shares here and roll that into, like I said, the two positions I'm looking at: Accenture, ticker ACN, and MasterCard, ticker MA. If you'd like to go look at those before I make my moves this week, probably going to do something similar that we did to Domino's Pizza, around 40 to 50 shares of MasterCard, and then probably 100 to 120 shares of Accenture is what I'm looking at, taking the funds from Google and rolling into those positions, both of which I feel are well undervalued and much more undervalued than Google is right now, which I feel like Google is overvalued actually, based on my discounted cash flow analysis. This one is one I would, again, love to be paying $200 per share, and if it was at $200 per share, we'd still be adding to Google, but I'm not adding to it at $400 per share or over $400 per share, which I think is where it's headed. All right, that's really the update for this one. Let me know what you think of those changes. I know a lot of you love Google. I love Google. I think it's a great, great company. It has nothing to do with the company. It has to do with the valuation, right? I am learning to separate the company from the valuation, and I'm going to let the rules of the portfolio dictate whenever I sell positions. If a position is vastly overpriced or overvalued, and I have opportunities in undervalued positions, I'm going to sell off. What I'm really going to do is run, just like I did with Google, run covered calls on those shares. And if they get called away, then I'm going to roll those funds into other ones. I'm going to start doing those with all of the positions. Johnson & Johnson right now is potentially on the chopping block. And really what I'm going to do is start running covered calls on this one. And then if it gets called away, I'll roll those funds into better opportunities. Procter & Gamble is undervalued right now, so I'd like to add to this one while it's undervalued. But again, the dividend growth has me questioning, and if, let's say, next year at this time they raise their dividend and again by 3%, I'm probably looking at selling out of this and rolling those into ETFs that are offering me better dividend growth with higher dividend yield. Just how I'm looking at the overall portfolio, what does each position offer me that a ETF potentially doesn't? And if they don't offer me something that those ETFs potentially doesn't, is it worth holding those shares? All right, let me know what you think of that approach. It is maybe a little bit of a shift in thinking of the overall portfolio and holding individual positions versus holding individual ETFs. But that's how I'm looking at it. You know, I can get into growth ETFs, I can get into SCHD, I can get into VTI, which is everything. So a individual position needs to offer me something that those three VXUS, those ETFs that I hold, don't offer me. And if they don't offer me something, they're vastly undervalued. That's what they offer. Much faster dividend growth, double-digit dividend growth. Maybe that could be what they offer. Much higher dividend yield. That could be what they offer. But I'm starting to compare each individual position to the ETFs that I'm holding and saying, do they offer a better opportunity, or am I better off just having those funds in the ETFs, which presents less volatility and less risk. All right. That's really it. I'll stop mumbling and rambling on. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit the thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So drop all of your questions down below. If you have questions of why I would sell off Google and don't quite understand it, let me know. Let me know what you think of Accenture and MasterCard, which is where I'm looking at putting those funds. Or maybe you think there are better opportunities. Let me know those better opportunities down in the comment section down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, what's left of it anyway, and a great week coming up. And we'll see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion. Investment journal for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria or seek the advice and counsel of a certified financial advisor.